Lesson 2.2 will deal with fixed income securities and the fixed income market. We will deal with specific securities dealt with in the fixed income market, the types of those securities, their issuers, and the features that can be attached to those securities. We have said before that the financial markets can be divided into two markets, the money market and the capital market. The capital market is comprised of three different types of securities, and we refer to them as three different markets. The fixed income market is the market that is comprised of fixed income securities. The capital market is the market where we deal with equities or shares, and the derivative market is the market where derivative securities are sold. Capital and derivative markets will be dealt with in further chapters. In this lesson, we will deal with a number of fixed income securities. We have listed 6 here. You will notice that the first 5 are all types of bonds. The difference for most of them lies in who the issuer of the bonds are. The final security listed is a mortgage-backed security, which is different from the bonds in a number of ways. We will talk about each of these securities in detail in the coming slides. The information listed on this slide with regard to Canada Savings Bonds details a number of important pieces of information on this type of security. Canada Savings Bonds are bonds that are issued by the federal government of Canada. They're different than other types of bonds because these are considered to be non-marketable. Other bonds issued by the federal government are marketable. The difference is that non-marketable bonds cannot be sold from one investor to another. Marketable bonds can be sold from one investor to another. We will deal with this a little bit further on in the list. Canada Savings Bonds are considered to be very liquid. The reason for this liquidity is that at any given time, an investor who holds a Canada Savings Bond can take the bond into a financial institution and redeem the bond for the face value plus any accrued interest. This is different than other bonds. With other bonds, if you want to cash in your bond, you must sell it to another investor. Canada Savings Bonds come in 2 different types, regular or compound interest. With a regular bond, you receive your interest every year as it is paid. Interest checks are sent out to the investor. With compound interest bonds, the interest is paid but is not received by the investor. Instead, it is reinvested in the bond and the interest is compounded. Canada Savings Bonds always sell for their face value. For a $1,000 Canada Savings Bond, you pay $1,000. This is different from T-bills, which you will recall always sell at a discount. The reason for this is because Canada Savings Bonds pay interest. The interest, as we've mentioned before, is paid every year and may be received by the investor or may be compounded and reinvested. Canada Savings Bonds pay the principal, or in the case of our $1,000 Canada Savings Bonds, the $1,000 face value, plus interest at maturity of the bond, if the bond is held until maturity. If the bond is not held until maturity and cashed in early, the accrued interest is provided at that time. Canada Savings Bonds can be purchased at chartered banks and many securities firms. We mentioned before that the major difference between Canada Savings Bonds and other bonds issued by the federal government is that they cannot be sold from one investor to another. This is what we mean by non-transferable. The terms non-transferable and non-marketable are interchangeable. Again, another difference with Canada Savings Bonds from other bonds is that Canada Savings Bonds values do not rise and fall with changes in the interest rates the way that other bonds do. We will see this relationship later on as we discuss more about bonds. Marketable bonds that are issued by the federal government have a number of characteristics listed on this slide. The first is that they tend to be long-term investments. Marketable bonds, or Federal Government of Canada bonds, can be issued with terms to maturity of 30 years or more. They are always non-callable. This means that the federal government cannot call the bond in at a date prior to its maturity. Other bonds are callable. We will discuss this feature later. The coupon payment that is attached to a federal government bond is usually paid semi-annually. The coupon payment is another term to refer for the interest that is paid. On an 8% federal government of Canada bond, the bond would pay 4% every 6 months, 4% of the par value. So if you had a $1,000 bond, on an annual basis, the 8% bond would pay $80 in interest, and it would pay that in 2 semi-annual payments of $40. Federal Government of Canada bonds are marketable. They are transferable. This means that they may be sold from one investor to another. This investment type of trading is done on the secondary market. We'll talk more about the secondary market later on. Provincial and municipal bonds act very much the same as federal bonds. They are marketable, they are longer term to maturity, they are transferable. The difference is in who the issuer is. The issuers for these two types of bonds are either provincial governments or municipal governments, such as the town of Woodstock. More often it would be places like the city of Toronto. Because these are issued by lower levels of government, they are considered to have higher risk. The risk on a bond is attached to the concern as to whether the bond issuer will be able to pay the interest payment on the bond each year or semi-annually through the year, and the principal amount when the bond matures. With federal governments, we have very little concern for risk. Whereas with provincial and municipal governments, there is a little bit more concern with regard to risk. Federal governments have supreme powers of taxation, so we feel that the federal government will always be able to pay their debt, whereas the provincial and municipal governments don't have the same level of taxation power and therefore may have a little bit more difficulty with repayment. The final type of bond that we'll deal with is that of the corporate bond. They are essentially just that, a bond that is issued by corporations. We often say that a corporation has floated a bond issue to raise money. Just like with the federal and provincial government bonds that we've dealt with, the coupon payments are usually semi-annual. The interest rate that is quoted on the bond, or the coupon rate, is always quoted in an annual fashion, and the semi-annual payment would be half of the annual rate. We consider corporate bonds to have the highest amount of risk of all of the types of bonds because corporate bonds being backed by corporations have varying levels of security behind them. Some corporations are stronger than others. Some corporations make more money than others and have longer histories behind them. Those would be the ones that would have the lower amount of risk, and then other smaller corporations or new corporations that are rather untested would have the highest amount of risk behind them. Government bonds, whether federal or provincial or municipal, have some taxation power in order to be able to make the payments on their bonds, whereas corporations must rely on their ability to make money to be able to make the interest payments and the principal payment when the bonds come due. We do, however, refer to bonds as being less risky than shares. A couple of reasons for this. The first one that I've listed on the slide is that when a company goes into receivership or bankruptcy and their assets are liquidated, the debt holders and the creditors are the people who receive their money first. So bondholders are considered equal to the bank as a credit holder in line for payment. So the bondholders would receive their money first, then the preferred shareholders, and then finally the common shareholders would receive whatever residue is left. So that's one reason that bonds are considered less risky than shares. And then the second reason is that when bonds are issued, the interest that is paid on the bond has to be paid, whereas dividends don't have to be paid. The board of directors makes the determination each year as to whether they will pay dividends. The interest is a contractual obligation for the government or the corporation and has to be paid, and if it's not paid, the debt holders can force the corporation into bankruptcy. The final type of fixed income security that we'll deal with is a mortgage-backed security. And this is a little different than bonds, because what we're dealing with here essentially is an entity that has issued mortgages, residential mortgages, for instance, and they have a number of people who owe them money on those mortgages, and all of the mortgages are backed by Canada Mortgage and Housing Corporation, CMHC. And basically, just to explain that, CMHC provides insurance against default on a mortgage. So if I have a mortgage with the CIBC and I have CMHC insurance on it and I don't pay my mortgage, then CMHC agrees that they will pay the bank the full amount of the mortgage that's outstanding, and they will then pursue foreclosure on the home to regain their money. So there's not a lot of risk involved with CMHC-backed mortgages because of that. So when the institutions have a bunch of mortgages that are outstanding to a large number, or for a large number of clients, and they don't want to wait 25 years to get their money on those mortgages, they can bundle them together and sell something called a mortgage-backed security. So it's a security that's backed by a number of those mortgages, and individual investors like you and I would be able to purchase part of those, and basically instead of the bank receiving the mortgage payments from the clients, we would be receiving the mortgage payments from the clients. The bank will receive their money early, so we purchase them at a discount to what they would receive 25 years from now, and we receive the payments and the interest over time rather than the bank. Now I have some bond definitions here, just a few things that I want you to be able to recognize with regard to bonds. The first one is the idea of bearer bonds versus registered bonds. Basically, a bearer bond is a bond that doesn't have any person's name attached to it. Essentially, the person who is holding the bond is considered the owner of the bond, whereas a bond is registered to a particular individual. The next one is the coupon, which we've already talked about. That's just another name for the interest rate that is attached to the bond. So if the bond is an 8% 5-year bond, then the coupon rate on that bond is 8% per year. And it will be received every year for 5 years. The par value is the face value of the bond. So if we have that 8% 5-year bond and we purchase it for a par value of $5,000, that means it's a face value of $5,000. We would purchase it, hold it for 5 years. We would receive 8% of the $5,000 every year in interest or coupon payments. And then at the end of the 5 years, we would receive the $5,000 par value from the issuer. The next definition that I have listed is that of bond risk and bond rating. And basically what I want to point out there is that we've talked about the fact that different bonds have different levels of risk. Federal government bonds are the lowest risk, then provincial, then municipal, and then the corporate bonds being the highest. And within the corporate structure, we also have some corporate bonds being relatively risk-free, not risk-free, but low risk, and then others that are riskier. So what we have in place is something called a bond rating system, where a few different companies, Moody's, the Dominion Bond Rating Service, and some others, will provide ratings for companies based on their risk level. So if I owned a company and the company was very strong, had strong earnings, strong coverage ratios, etc., strong repayment record, I would receive a AAA rating, whereas someone who had less stellar past results might have a BB rating. So the ratings go from best to worst, and A down to D, and in default, and so on. The next thing that I have listed is something called a sinking fund, and we will deal with sinking funds later on in a lot more detail, but what I want to deal with here is just the idea that as part of the bond package that an investor buys, sometimes there will be a sinking fund attached to that bond, which means that, let's say that the company has $50 million worth of bonds that they're issuing today, and they're 25-year bonds. So that means 25 years from now, the company is going to have to repay $50 million. Investors might be a little concerned about a company's ability to pay that amount of money all at once. So if a sinking fund may be put in place that will allow the company to put the $50 million away over time so that they will have that money when 25 years is up, or they may actually structure it so that every year over the 25 years they actually pay off a certain number of the bonds. So either way that it's structured, the sinking fund allows the investor to feel a little bit more peace of mind about the company's ability to make good on that payment. And then finally, within the bond definition slide here, I have something that lists bond prices and interest rates. And this is an essential relationship with bond pricing, that of the inverse relationship between bond prices and interest rates. Essentially what we mean is that when interest rates within the market increase, the value of bonds decreases. And when interest rates in the market decrease, the value of bonds increases. The reason that this happens is because bonds have, for the most part, fixed coupon rates, fixed interest rates attached to them. So if I have a bond that was issued today and it paid a 6% coupon rate, and I held it for 2 or 3 years, and during that time, the interest rates in the market started to go up, so that other companies that were issuing bonds that were very similar in risk to the bond that I hold were now paying a 9% coupon rate. My bond that only pays 6% is not worth as much anymore, so the bond price goes down. Essentially, that's the way that it happens. What in fact is happening is that the bond price is being reduced so that someone who buys my bond will also be receiving a 9% return, just the same as the person who's buying the new bond is getting a 9% return. The person who buys my bond will be getting a 6% coupon, but they'll be making up extra money because they're paying less for my bond than what it will mature at. So they're getting an extra 3% there. So what happens is that bond prices are set to provide a particular return, so that everyone who is taking the same amount of risk is getting the same amount of yield or return. I've listed several types of corporate bonds here, and I'll just go through the definitions of these types of corporate bonds. The first one is a secured bond, which is pretty self-explanatory. A secured bond is a bond that is secured by some type of an asset. It means that if the bondholder were to default on the bond and not make the payments that they're supposed to pay, the investors would have an asset that could be liquidated in order to pay them. The second thing that is listed is called a debenture, and this is nothing more than another term for an unsecured bond. So it means that the bond is not secured by any type of asset. The third type is something called a subordinated debenture, which means that it is a debenture, which means it's unsecured, but it is subordinate to some other security that the issuing company also has outstanding. It means that it comes second to some other security in terms of its place in line for repayment. And then the final type of bond that I've listed is a serial bond, which is essentially a bond that has a series of maturity dates, so that part of the bond will mature each year. So you will receive a portion of your principal amount each year until the bond fully matures. And finally, we have some bond features listed that I want you to be able to discuss. The first one is the callable or redeemable feature. And basically, if a bond has a callable or redeemable feature attached to it, it means that that bond can be called in by the issuer for a set price within a certain time. So the issuer can call them in and retire those bonds regardless of whether the investor who holds the bonds wants to sell it at that point. This means that the issuer is probably going to pay some sort of a premium for having made the investor give their bond up early. And it also means that because this feature is to the benefit of the issuer rather than to the investor will probably pay less for this type of a bond. The second type that I've listed is an extendable bond, and it goes hand in hand with the retractable bond that's listed next because they're sort of opposite to one another. An extendable bond is a bond that has a maturity date listed, let's say May 12th, 2008, but it also says that the bond can be extended beyond that. So within a certain period of time, called the election period, the investor can choose whether to extend that bond maturity date further if they want. So instead of having it May 12, 2008, they might be allowed to extend it to May 12, 2013.
A retractable bond is exactly the opposite. It has a stated maturity date, but there's also a period of time during which the investor can choose to have the bond mature early if they want, at a set date. So it might be from 2013 back to 2008, for instance. In both of these cases, the benefit is to the investor because the investor gets to make that choice. This means that an investor would pay a little bit more for a bond that has one of these features. The fourth feature that I listed is something called a convertible feature. And if a bond has a convertible feature attached to it, it essentially means that the bondholder can choose to change that bond into shares of the same company if they want. So if I own an ABC convertible bond, there will be a conversion value on that bond that says that my conversion ratio is maybe 5 common shares for every 100 face value of the bond. So at any time that I decide that I want to convert it, I can take every $100 face value of that bond and convert it for 5 common shares of the same company. And then finally, I've listed a zero coupon bond, which again sounds pretty much like what it says. It's a bond that doesn't have any coupons attached to it. It's often also called a strip bond. It means that the coupons have been stripped away from the bond so that all we have is the residue. It's what's left over. So this would always sell at a discount to par because you're not receiving any coupon payments on it. You're just going to receive the maturity amount at maturity.